If you're considering getting a home equity agreement, but you're not sure exactly what it is or how it works, you're in the right place. Hi, I'm Katherine Collins, reporting for Lend EDU, a company that helps you navigate the path to financial freedom through our guides, tips, and expert research. By the end of this video, you'll understand exactly what a home equity agreement is, how it works, the eligibility requirements to get one, and how to apply. So, what is a home equity agreement? Sometimes you'll hear people refer to them as home equity investment or a home equity sharing agreement. Many shorten the name to HEA, HEI, or HESA. In this video, we'll use the term home equity agreement and HEA. So think of an HEA like the show Shark Tank. On Shark Tank, entrepreneurs pitch their businesses in hopes of finding a financial partner. The sharks, after listening to the pitch, decide if they believe the business will be worth more in the future. They make offers to purchase a portion of the business's equity. Later on, if the entrepreneur sells the business, the shark gets back their investment, plus more if the company has grown in value. HEAs work similarly to that, except instead of selling a part of the business, you're selling a portion of your home's future value. In exchange for that, HEA companies give you a lump sum that you can use for many different purposes, such as consolidating debt or renovating your home. One advantage of an HEA is that there are no monthly payments, unlike a home equity loan or a HELOC. Instead, you pay back the HEA company in the future, typically when you decide to sell your home, refinance, or buy back your equity. If your home appreciates in value, the HEA company earns back its original investment plus its agreed upon share of the appreciation. If your home depreciates in value, most HEA agreements have a risk adjustment clause where you won't owe the HEA company more than the home is worth. Your contract will outline the exact risk adjustment, stating how the HEA company will share in the loss and up to what limit. There are also annual cost caps, also called a safety cap, which will be outlined in your contract. These limit how much your HEA repayment can grow each year. So for example, your contract might say the safety cap is an annualized rate of 20%. That means even if you experience rapid home appreciation beyond that rate, the HEA company's return is still capped. Now, the amount an HEA company will give you depends on your home's current value, the equity you have, and the company's guidelines for the level of risk they're willing to take. HEA companies differ in the minimum and the maximum amounts they offer, but some will offer up to $600,000. Each HEA company uses a formula to calculate how much your repayment will be. However, not all company formulas are identical. Generally, you'll repay the initial amount you received plus a percentage of your home's appreciation. Some, but not all HEA companies add on something called a multiplier, which is an extra cost added on to the total to account for the company's risk. Home equity agreements also come with fees, including appraisal fees, origination fees, and title fees. But HEA companies typically deduct these fees from your dispersed funds. Now, there are a few ways to pay back your HEA company. The first way is to sell your home. This would be the equivalent of Shark Tank, where another business acquires the company and the sharks get a payout when the deal closes. You can also repay your HEA company by refinancing or using your own funds to buy back your equity. Now, term length refers to the number of years you have a home equity agreement before your contract will require you to sell, refinance, or buy back your equity. The term lengths typically range from 10 to 30 years. And most HEA companies include home improvement adjustments in their contracts too. So that means if you pay for renovations that increase your home's value, you get to keep the added value, not the HEA company. Many contracts also include something called a maturity match, which means the HEA term will fit your personal timeline. That way, the contract term won't end before you're ready to sell or buy back your equity. All right, now that you know how an HEA repayment works, here are several eligibility requirements HEA companies consider before making you an offer. Now, the first eligibility requirement is your property type. Some HEA companies require your home to be your primary residence and a single-family home, townhome, or condo. However, other companies will accept multi-unit or investment properties. Another important eligibility requirement is your LTV ratio. This is a percentage that shows your current mortgage balance divided by your current home value. This shows how much of your home is leveraged by the bank. If you have a high LTV ratio, it means that you have low equity. If you have a low LTV ratio, you have a high equity. When applying for a home equity agreement, most HEA companies require you to have an LTV of 60% to 80%. Next is your credit score. Home equity agreement companies usually have very flexible credit score requirements. Unlike HELOCs or home equity loans, many HEA companies are willing to offer home equity agreements to homeowners with credit scores as low as 500. Like the other eligibility requirements, each HEA company sets its own minimum credit score. However, generally, if you don't qualify for other options, you may still be eligible for a home equity agreement. Home equity agreement companies are also much more lenient on DTI qualifications than other types of products. For example, when applying for a mortgage, a HELOC, or a home equity loan, most lenders require a debt-to-income ratio of 43% or less. Now, you calculate your DTI by dividing your total monthly debt payments by your gross monthly income. The percentage you get shows lenders how much of your monthly income is tied up in debt, which can indicate whether or not you have stable finances. HEA companies are different. Many do not have DTI requirements at all because home equity agreement eligibility is based more on your home's value and the equity that you have in it. Okay. Now that you know how a home equity agreement works, you can decide whether or not it's a good fit for you. If you want to apply for one, here are the steps to take. The first step is to see if your home is eligible for a home equity agreement. You can pre-qualify with several HEA companies to compare their terms. Now, make sure to review customer ratings, fees, repayment terms, and geographic availability before choosing a company to pre-qualify with. You can pre-qualify online and it only takes a few minutes. You'll need to enter your home address and answer a few questions to get an estimate. If an HEA company determines you are eligible and you want to move forward with the process, you will need to get a home appraisal. The HEA company will either order an in-home appraisal or they'll use an online automated valuation model. That will determine your home's value so the HEA company can make you an offer. After reviewing the offer, the terms, and the fees, you sign the agreement if you want to move forward. And remember that getting a home equity agreement will likely require paying closing costs before finalizing your agreement. Once you've signed the agreement, the HEA company will disperse funds to your bank account. Disbursement can take a few days depending on when you sign and how long it takes for your bank to process the deposit. Now you know exactly how a home equity agreement works and how to apply for one. For more information about home equity agreements, including our top picks for HEA companies to use, please visit lendedu.com.